Good day to doctor and everyone. My name is DHARSHINI Krishnamurthy and my matrix number is 303558. I will be presenting my individual report, The Determinants of Livzon Pharmaceutical Group Incorporated Performance. This study aims to identify the determinants of internal and external variables that has impact on firm's profitability for the owners, which is ROE of Livzon Pharmaceutical Group Incorporated. We look into the company's background. Livzon Pharmaceutical Group Incorporation is a well-established pharmaceutical company that was founded in 1985 and is headquartered in Zhuhai, China. The company operates both domestically and internationally, focusing on research, development, production, and sale of pharmaceutical products. Its business activities covers a wide range of healthcare segments, including biochemical, biological, and traditional Chinese medicine. Livzon has a diversified product portfolio that includes drugs for reproductive health, gastrointestinal disorders, neurological and psychiatric treatments, as well as the antiviral and antibiotic products. In addition to finished pharmaceutical products, the company also manufactures active pharmaceutical ingredients and intermediates, which are essential components in drug production. Furthermore, Livzon is involved in producing diagnostic tools such as test kits, which support disease detection and healthcare monitoring. This broad range of operation allows Livzon to reduce reliance on a single product line and strengthen its position in the pharmaceutical industry. However, operating in such competitive and regulated industry also exposes the company to operational, financial, and governance-related challenges, making it important to analyze the factors that influence its overall performance and profitability. Moving on to the problem statement of this study. Despite Livzon Pharmaceutical Group Incorporation being a well-established company, several financial and performance-related concerns justify the need for this study. Firstly, the company's current price-to-earning ratio is 15.2 times, which is significantly lower than its fair price-to-earning ratio of 27.3 times. This suggests that Livzon's share may be undervalued by the market, indicating a potential mismatch between its fundamental and investor perception. In terms of growth, Livzon is expected to experience moderate earnings and revenue growth, which are noticeably lower than industrial average. This weaker growth outlook raises concern about the company's ability to remain competitive in China's rapidly evolving pharmaceutical and healthcare market. Factors such as limited innovation, pricing pressure, or strong competition may be contributing to this slower growth. Although Livzon records a return on equity that is higher than the industrial average, the level is still considered moderate, suggesting there is room for improvement in profitability and capital utilization. Additionally, while the company maintains a strong liquid position and a manageable debt levels, the increase in leverage over time requires close monitoring. Other concerns include inconsistent dividend payments, executive composition that appears high relative to company performance, and limited insider trading information, which makes it difficult to access management confidence. Together, this issue highlights the importance of examining both internal and external factors that influence Livzon's profitability and overall performance. Now, the research objective of this study. First, to determine the impact of firm-specific factors on Livzon Pharmaceutical Group Incorporation's profitability for the owners. Second, to determine the impact of macroeconomic factors on Livzon Pharmaceutical Group Incorporation's profitability for the owners. Third, to determine the impact of firm-specific factors and macroeconomic factors on Livzon Pharmaceutical Group Incorporation's profitability for the owners. For this study. First, does the impact of firm-specific factors on Livzon Pharmaceutical Group Incorporation's profitability for the owners? Second, does the impact of macroeconomic factors on Livzon Pharmaceutical Group Incorporation's profitability for the owners? Third, does the impact of firm-specific factors and macroeconomic factors on Livzon Pharmaceutical Group Incorporation's profitability for the owners? Literature review of this study. The literature review provides a theoretical foundation for analyzing determinants of firm performance. This study focuses on both internal and external variables, particularly corporate governance, profitability, liquidity risk, credit risk, and operational risk. Corporate governance refers to structures, processes used to direct and control companies' activities. Prior studies suggest that strong corporate governance enhances transparency, accountability, and investor confidence, ultimately leading to improved firm performance. Conversely, weak governance can result in operational failures, financial losses, and reputational damage. Profitability ratios such as return on asset and return on equity are commonly used to measure firm performance. ROA reflects how efficiently company uses its asset to generate profit, while ROE measures the return generated for shareholders. Both indicators are widely adopted in previous studies as reliable measures of financial performance. Liquidity risk relates to a firm's ability to meet its short-term obligation. Proper liquidity management ensures business continuity and maintains stakeholder confidence. Poor liquidity management, on the other hand, can weaken financial stability and damage a firm's reputation. Credit risk arises when borrowers or counterparties fail to meet their payment obligation. Measures such as the average collection period and account receivable turnover are often used to assess how effectively a firm manages its credit activities. Longer collection periods are generally associated with a negative impact on profitability. Finally, operational risk originates from failures in internal processes, system, or human behavior. Prior research highlights that operational risk plays a crucial role in determining firm performance, as inefficiency can increase costs, disrupt operation, and harm profitability. Therefore, effective operational risk management is essential for sustaining long-term firm performance. Moving on to the methodology of this study. For sampling techniques, the data collected from Livzon Pharmaceutical Group Incorporated annual report from 2015 to 2024. There are three models in this study. Model 1 represents how internal variables relate to profitability for the owners. Model 2 represents how external variables relate to profitability for the owners. Lastly, Model 3 represents how both internal and external variables relate to profitability. The internal variables used in this study are ROA, ROE, operating profit margin, net profit margin, current ratio, quick ratio, cash ratio, average collection period, account receivable turnover, inventory turnover, debt to income, debt to asset, operational ratio, operating margin, total asset turnover, and CG index. The external variables used in this study are GDP growth, inflation rate, interest rate, exchange rate, unemployment rate, consumer price index, export on goods and services, foreign direct investment, and government effectiveness. The ratio will be analyzed through the linear regression by using SPSS version 27 to generate descriptive statistics, correlation, model summary, ANOVA, and coefficient. Based on the descriptive statistics, two variables stand out as the most significant in explaining Livzon Pharmaceutical Group Incorporation's performance. The first is return on equity (ROE), which has a mean value of 0.174. This indicates that on average, the company generated a return of 17.4% for its shareholders over the 10-year period. However, the relatively high standard deviation shows that ROE fluctuated considerably across the years, suggesting instability in shareholder returns and highlighting the importance of improving internal efficiency to achieve more consistent profitability. The second significant variable is the operational ratio, which has a mean of 0.623. This means that approximately 62.3% of Livzon's revenue is used to cover operating expenses. This high proportion indicates that operation cost plays a major role in determining overall profitability. As a result, even a small inefficiency in operations can have a significant impact on the company's financial performance, explaining why operational risk later emerged as a key determinant of ROE. On the other hand, some variables appear to be less significant in influencing Livzon's performance. One example is average collection period, which has high mean of about 169 days. Although this suggests slow collection of receivables, its variability over time indicates inconsistency rather than a clear pattern affecting profitability. This implies that credit management is not a primary driver of Livzon's overall performance. Moving on to the correlation analysis, the results show several important relationships between the independent variables and Livzon Pharmaceutical Group Incorporation's return on equity, which is used as the main indicator of firm performance in this study. The most significant finding is the strong positive correlation between ROE and profitability measures, particularly ROA, operating profit margin, net profit margin, operating margin, interest rate, and debt to income. These variables show very high correlation with ROE, indicating that as Livzon becomes more efficient in using its asset and generating operating profit, the returns to shareholders increase significantly. This highlights that profitability and operational efficiency are key drivers of shareholders' value, and improvements in these areas directly translate into higher firm performance. In contrast, other variables that is not significantly correlated with ROE, which are current ratio, quick ratio, cash ratio, average collection period, accounts receivable turnover, inventory turnover, debt to asset ratio, operational ratio, total asset turnover, CG index, GDP, inflation rate, interest rate, exchange rate, unemployment rate, consumer price index, export foreign direct investment, and government effectiveness, as the p-value is more than 0.10. Overall, the correlation analysis supports the conclusion that internal profitability and operational efficiency are far more important determinants of Livzon Pharmaceutical Group Incorporation's performance. This external economic model summary results by focusing on the adjusted R-square values, which shows how well each regression model explains variation in return on equity after accounting for the number of variables included. Model 1, which includes internal variables, records an adjusted R-square of 0.997. This means that 99.7% of variation in ROE is explained by internal variables such as profitability ratios, operational efficiency, liquidity, and cost-related variables. This extremely high explanatory power indicates that internal management and operational performance are the primary drivers of Livzon Pharmaceutical Group Incorporation's ROE. Model 2, which consists of external variables, shows a much weaker result. Although the R-square is 0.285, the adjusted R-square is negative 2.218, which indicates that once the number of predictors and the sample size are taken into account, external variables do not meaningfully explain ROE. This negative adjusted R-square suggests that factors such as GDP growth, inflation, interest rate, exchange rate, and unemployment rate have very limited explanatory power on Livzon's profitability when considered on their own. Model 3, which combines both internal and external variables, records an adjusted R-square of 0.99, the highest among all three models. This shows that 99.9% of variation in ROE is explained when both internal and external variables are included together. Therefore, Model 3 is the most powerful model in explaining ROE. However, the improvement from Model 1 to Model 3 is very small, indicating that while external variables add slight internal explanatory variable to internal variables remain the dominant contributors to Livzon's Pharmaceutical Group Incorporation financial performance. Overall, the model summary clearly demonstrates that internal variables are far more important than the external variables, and the combined model provides the strongest and the most comprehensive explanation of ROE. This slide presents the ANOVA results, which are used to test whether each regression model is statistically significant overall. In other words, the ANOVA test examines whether the independent variables as a group have a meaningful effect on the return on equity. Starting with Model 1, which includes internal variables, the ANOVA results show an F statistic of 232.759 with a p-value of 0.000. Since the p-value is less than 0.01, this model is highly statistically significant. This indicates that the internal variables jointly have a strong significant impact on ROE. Therefore, we can confidently conclude that internal variables are important in explaining Livzon Pharmaceutical Group Incorporation's financial performance. Moving on to the Model 2, which consists of external variables, the ANOVA table reports an F statistic of 0.114 with a p-value of 0.988. Because the p-value is much greater than 0.05, this model is not statistically significant. This means that external variables, when considered together, do not significantly explain variations in ROE. As a result, external economic conditions alone are insufficient to account for Livzon's profitability during the study period. Finally, the Model 3, which combines both internal and external variables, shows an F statistic of 115.569 with a p-value of 0.072. Since the p-value is slightly above the 0.05 significance level, the model is considered not statistically significant at the 5% level, but it shows moderate significance at 10% level. This suggests that while the combined model improves explanatory power, the inclusion of external variables slightly weakens the overall statistical significance compared to the internal-only model. Overall, the ANOVA results clearly demonstrate that Model 1 is the strongest and the most statistically significant model, while Model 2 is not significant and Model 3 shows moderate significance. These findings reinforce the conclusion that internal variables are the main determinants of Livzon Pharmaceutical Group Incorporation's return on equity rather than macroeconomic coefficient results, which explain the individual impact of each independent variables on return on equity. The focus is identifying which variables significantly influence ROE based on their p-values. The most significant variables are internal profitability and operational factors. Net profit margin is a stronger determinant of ROE with a positive coefficient of 0.607 and a p-value of 0.000, indicating the higher profitability significantly increases shareholder returns. Inventory turnover is also positively significant with a p-value of 0.005, showing that efficient inventory management contributes positively to ROE. In contrast, external variables are not statistically significant. Variables such as GDP, inflation rate, unemployment rate, consumer price index, export foreign direct investment, and government effectiveness all record p-values greater than 0.10, indicating no meaningful impact on ROE. This suggests that Livzon Pharmaceutical Group Incorporation profitability is not strongly influenced by external economic conditions during the study period. In the combined model, operating margin remains statistically significant with a positive coefficient of 0.5074 and a p-value of 0.023, reinforcing the importance of cost control and operational efficiency. Overall, the coefficient analysis confirmed that internal variables are the primary drivers of ROE, while external variables play a limited role supporting the earlier findings from the model summary and the ANOVA results. In conclusion, this study aimed to examine the factors that influence the profitability of Livzon Pharmaceutical Group Incorporation by analyzing both internal and external determinants. The analysis was conducted using the financial and economic data over a 10-year period, with return on equity used the main indicator of company's performance. The findings indicate that the internal variables have a much stronger influence on Livzon profitability compared to external variables. In particular, operational risk emerged as the most significant determinant affecting the company's return on equity. This suggests that inefficiency in internal processes, cost management, and operational control play a crucial role in shaping the company's financial performance. Although Livzon demonstrates a relatively stronger liquidity position, manageable debt levels, and an ROE that exceeds the industrial average, its overall profitability remains moderate. This indicates that the company has the capacity to generate shareholders' returns but has not yet fully maximized its potential. Additionally, the weaker impact of external variables implies that Livzon's performance is driven more by internal managerial decisions rather than changes in the broader economic environment. Overall, the study highlights that the strengthening internal management, particularly in operational efficiency and risk control, is essential for improving Livzon Pharmaceutical Group Incorporation's long-term profitability and shareholders' value. Based on the findings of this study, several recommendations can be proposed. First, Livzon should place greater emphasis on improving operational efficiency by strengthening the internal controls, streamlining process, and reducing unnecessary operational costs. Since operational risk was found to be the most significant determinant of profitability, improving this area could lead to substantial improvements in return on equity. Second, the company should enhance its corporate governance practices to ensure better alignment between the management decision and the shareholders' interests. This includes reviewing executive compensation policies to ensure they are closely linked to company performance, particularly in terms of profitability and growth outcomes. Third, Livzon should invest more in innovation and product development to address its relatively weaker growth prospect compared to industry peers. Expanding its product pipeline and improving research and development capability could help the company remain competitive in the rapidly evolving pharmaceutical industry. In addition, while Livzon's debt levels are currently manageable, the increase in leverage over time should be carefully monitored. Maintaining prudent debt management and leveraging strong operating cash flow will help preserve financial stability. Finally, for future research, it is recommended that studies include larger sample size, longer study period, and additional variables such as market competitiveness or technology innovation. This will provide more comprehensive understanding of determinants of firm performance in the pharmaceutical sector.